Welcome back. We are now going to walk through certain important tables, entries, and other information in chapters 3 and 4. Let's begin with table 3.1. I like this table because it gets across the point that the words debit and credit are actually just labels. They're terms. Something happens, and we give that something, that event, or that occurrence a label. What happens if you have an asset that increases in value? Let's say we do some work for someone, and they give us cash. Well, then cash, an asset, would increase, and we call that increase a debit, which is what you see happening on the first line of table 3.1. Let's go to the second line. Let's say we have a liability that increases. Somebody does work for us. We promise to pay them later. Our account balance, what we owe them, has increased. We owe them more money. We would then label or call the increase in the liability a credit. It's just a different label than the word debit. Now, what about equity value numbers? What about common stock value or retained earnings value? Well, when value goes up, whether it's because an investor gives us money, that would be common stock value, or because we do something to work hard and earn value, well, that would be revenue. That increase in value is labeled a credit. That's why common stock and revenue on table 3.1 are labeled credits when they increase. Now, what you don't see in 3.1 is the fact that when these balances go down or decrease instead of increase, you give them the other label. So based on 3.1, table 3.1, we know if an asset goes up, we call the increase a debit. What is implied here is that when an asset goes down, we would call the decline a credit. When a liability goes up, according to table 3.1, we call the increase a credit. Well then, if a liability were to go down or decrease, we would call the decrease a debit. What happens if value goes down because we're working hard to earn value? Well, we would call that decrease of value an expense. And if value goes up and we call it a credit, then when value goes down, we would call it a debit. Okay? To summarize table 3.1, assets go up, you call the increases debits. Liabilities go up, you call the increases credits. Value items like common stock and revenue go up, you call them credits. The go down labels are just the opposite. Assets go down, those are credits. Liabilities go down, those are debits. Equity value or worth items go down, you would also call them debits, and they are expenses. And that's how to make sense of Table 3.1. I now want to take you over to the book section, or the chapter, I should say, chapter section 3.5 is titled Recording Transactions. Okay, so scroll down, move down to 3.5, and actually I should say the subtitle for all of 3.5 is Use Journal Entries to Record Transactions and Post to T accounts. But within that subsection of the chapter 3.5, there is a smaller section called Recording Transactions. It gives you a list of 12 different types of transactions. And I am going to walk you through 2 or 3 of these illustrative transactions. Okay, let's look at the first one. Let's look at number 5 of 12. On January 12th, 2019, we pay a utility bill, basically an electric bill, with cash, and we spend $300. What the textbook does is as follows. They show you the debit and the credit in journal entry format. And then they show you how the transaction affects the chart that we talked through at the end of chapter 2. Let me begin with the chart though. That's the chart of assets, liabilities, and equity value. If we pay an electric bill, $300, we ask ourselves, have any assets changed? Yeah, cash has declined or decreased by $300. Have any liabilities changed? No. So, if assets have declined by $300, if liabilities have not changed, then the value of the company, equity value, has declined by $300 because assets minus liabilities equals value. When value increases as part of the earnings column, not common stock, when value increases because we're working to earn it, we call it revenue. When value decreases while we are working to earn profits, we call it an expense. And so what's happening here in transaction 5, and you see it in the second little table of the page in the textbook where transaction 5 is explained, assets are declining by $300 because we're spending cash. Value is declining by $300 because we are incurring an expense. In other words, value is declining. How do we express that in debit and credit format? Well, if an asset decreases, we call it a credit. And therefore, in the journal entry, we are crediting cash by $300. By the way, when we write journal entries, debits are never indented, credits are always indented. Value is also going down by 300. That's the expense. And whenever value goes down, we call it a debit. And that's why in the journal entry, we are debiting electric utility bill expense for 300. The book emphasizes that for any particular transaction, debits must always equal credits, and here the $300 debit equals the $300 credit. Okay, let's try another one. Let's go down to transaction number 8. On January 18th, 2019, we spend cash to purchase equipment. Now, apparently, we already got the equipment. However, when we received or took possession of the equipment, we told the equipment store, "We'll pay you later." And so, when that previously happened, we incurred a liability. It is now time to pay the store, to pay off that liability. And so how do we do that? Well, in transaction 8, you see, we're spending $3,500 of cash. That's an asset. But in doing so, we are eliminating or paying off our $3,500 liability. And so cash, an asset, is decreasing by $3,500. Liabilities, the accounts payable, are also decreasing by $3,500. If an asset and a liability each decrease by the same amount, assets minus liabilities or value do not change. What do we call or label the decline in cash? Declines in assets are labeled credits. What do we call or label the decline or decrease in the liability? Well, decreases in liabilities are called debits. And that's why in the journal entry transaction for transaction 8, we are debiting accounts payable and crediting cash for the $3,500. Once again, please note, we always do not indent debits. We always do indent credits. Okay. Let's do one more of this batch, of course. Transaction 11. We do some work for a customer. The customer says, "Can I pay you later?" And we say, "Sure." We now have a promise by the customer to pay us. That promise has value to us. The promise to receive cash from a customer in the future is called an account receivable. It's an asset. So when we do work and when a customer promises to pay us, do any assets change? Sure. An asset called receivable increases by $1,200. Have any liabilities changed? No. Well, if an asset goes up by $1,200. If a liability does not change, then assets minus liabilities or value also goes up by $1,200. And when that happens, the increase in value is called revenue. Which is the debit? Which is the credit? Well, when an asset increases, we call the increase a debit. When value increases, we call the increase a credit. We thus have a debit to the asset, the receivable, and a credit to the value item, revenue. Okay, I hope this is helpful. I wish to make a final comment for you regarding Chapter 4 and the concept of adjusting entries. What is an adjusting entry? Well, up to now, we have defined transactions as something that happens at a particular moment in time. And we know it's happening, and we can sit there and say, this transaction, this event has just happened. It has just happened. Let me think about whether or not any assets or liabilities have changed. However, what Chapter 4 addresses is the reality that sometimes you don't really know whether or not something is happening. Or something is happening, but not at just one moment in time. Instead, it's happening on a continuing basis. And so, to illustrate this with a couple of examples, in Chapter 4, and we're talking about 4.3, that's the sub-chapter number. We are recording and posting common types of adjusting entries here. Let's look at one or two. If you look at the example in the textbook, they list the 12 transactions that we've already talked about previously, but then they list 5 more adjusting transactions or adjusting entries that are made on January 31st. Let's talk about number 2. We have equipment. It depreciated by $75 over the course of the month. Well, what this means is we used the equipment all month. By the end of the month, it was worth $75 less than it was at the beginning of the month because it's older. It's becoming more used. Did that decline in value happen at a particular moment of the month? No. We've been using it little by little throughout the month. And little by little, on a continuous basis, it has been declining in value. And so, if you look at the explanation of the second adjusting entry, which is actually labeled transaction 14 by the textbook, you can see the asset, equipment, has declined in value by $75 this month. Equity value has thus declined by $75 too. A decline in the asset, or any asset, is called a credit. A decline in value is called a debit. And that is why in transaction 14, the second of 5 adjusting entries, we are debiting value, expense, and crediting the equipment. Okay, finally, let's try one more. Let's go to transaction 17, the 5th and final adjusting entry. Your workers have worked for you on a continuing basis. You get to the end of the month. They've been working every minute of every day. Well, hopefully only 8 hours a day, but who knows, maybe longer than that. You reach a point where you say, well, payday is not until the end of the month, but every minute that they're working for me, I owe them a little more money. And so at the moment when this transaction is recorded, it seems that the company owes its employees $1,500, but the amount is growing on a continuing basis. With every passing minute that the employees are working, more money is owed to the employees for salaries and wages. At that moment, one would say, okay, I owe them $1,500. My liability is increasing by $1,500. And thus, assets minus liabilities, or value, is decreasing by $1,500. A liability that increases, that's a credit. Value decreasing, well, that's an expense, and that's a debit. Which is why, for transaction 17, we're debiting the expense and we're crediting the payable. And that concludes our discussion of Chapter 4. Please keep in mind these are not discrete events. Equipment, as you use it, loses its value little by little. Employees, as they work, earn their pay little by little. So every once in a while, you need to adjust your records to account for the fact that the equipment is losing its value and that your liability to pay your employees is increasing in value. Or I should say, in negative value, because the debt or the obligation to pay them is going up. Thank you again for visiting chapters 3 and 4 with us, and I will see you in the next module for 5 and 6.